All right, so let's talk about a couple methods out here for estimating possible potential uncollectible accounts. Now, these are the accounts out there that we're looking not to get paid on. Now, one such method out there is something called the direct write-off method of accounts receivable, and we'll talk more about this in a little bit. Now, the direct write-off method, we're looking at a couple things here. Let's talk about some definitions first. Now, let's talk about bad debt expense. Now, bad debt expense, what we're looking at here, since you're offering credit sales, and we know not all the customers are going to pay us back timely, or if at all. What bad debt expense is really, we're looking at the failure of some customers to pay us back for purchases that were made on account. So again, there is going to be some customers, maybe some exact customers, maybe a percentage of customers based on company history, or some type of history that's out there, maybe industry average or something like that. But we're going to be estimating bad debt expense throughout this chapter. Now, there's two methods of accounting for uncollectible receivables. There's the direct write-off method, and then there's the allowance method, which is more GAAP approved. The direct write-off method not necessarily is GAAP approved because it fails to meet the expense and revenue recognition principles. The allowance method, this is good because we can run an estimate of our bad debt expense, and GAAP is okay with estimates, computing out estimates as long as there's some logic behind those estimates. So GAAP is okay with that. Now, in the direct write-off method, it says here that we're going to account for uncollectible receivables. We're going to record the bad debt expense when the customer account is uncollectible. Now, with something like this, it says that the accounts receivable are written off when the business determines it will never collect from a specific customer. Once it's written off, the company stops pursuing the collection. And again, normally that's the case. Now, with something like this, with Smart Touch Learning, they determined that they weren't able to collect $200 from customer Dan King, made on May 9th. So what Smart Touch is going to do if they use the direct write-off method is they're going to debit bad debt expense and credit the accounts receivable for King for $200. And that's, like I said, this one's a direct write-off of the account. Now, what happens if the account that was directly written off, the cash comes in? Surprise, on September 10th, Smart Touch unexpectedly received $200 in cash. Now, let me tell you, gang, from a professional perspective, when that happens, that's a nice feeling. So what's going to happen here is Smart Touch is going to have to reinstate that account. So they're going to have to make a debit to the accounts receivable King of $200 and credit the bad debt expense of $200 to reinstate that account. Then on September 10th, what they're going to do is apply the cash to the accounts receivable King account like it would normally do. So we're going to have a debit to cash here and a credit to AR for King for $200. So once we reinstate the account, then with the cash that we receive on that account, we'll normally put it against the accounts receivable in a normal entry like we would normally do. Now, the problem with the direct write-off method, as I originally stated, it violates the matching principle. Now, it says here in this example, a company records sales revenue in 2017 and the related bad debt expense in 2018. The problem is, if we're using the direct write-off method, we've overstated our income in 2017, understated the net income in 2018, and basically overstated our accounts receivable in 2017. So what we're not doing here is just matching up our revenue and expense, the matching principle that's out there. And again, with the direct write-off method, this is not GAAP approved. GAAP definitely does not like this. It likes more of the allowance method, which I'm going to talk about in a little bit. But again, if you are a very, very small company out there and you've got a company out there and you've got customers that are paying on their accounts, and you might have maybe one or two uncollectible receivables, I mean, it's okay to use the direct write-off method. But again, that's probably going to be far and few in between. And again, that's another reason why GAAP does not like the use of the direct write-off method. So in this case here, once an accounts receivable is written off, A, the account must be turned over to a collection agency. No. The company continues to pursue the account. B, no. C, the company still expects to be paid. Well, I'm sure it would like to be paid, but honestly, if it's written off, the odds on the expectation of being paid are pretty well gone. So C is not right. D, the customer's accounts receivable is removed from the books. Very, very true on this one. So number 6 is definitely going to be D. Now, let's take a look at some various methods out there in order to record uncollectible accounts and estimate bad debt expense. Now, we're going to be looking at 3 methods out there at estimating bad debt expense. We're going to take a look at the percent of sales, the percent of receivables, or the aging of accounts receivable. So let's get started on this. Now, we're going to be using something called the allowance method, and we're going to normally look at the allowance method to measure bad debts. Now, it mentions that the allowance method is based on the matching principle, in which we are going to maybe base some bad debt expense based on the actual revenue or sales or accounts receivable that we've had during the month. So we're going to record our bad debts in the same period as revenue. This follows along with the matching principle with the allowance method. Now, what we're going to be introducing in this chapter is something called a contra asset account. And contra asset account, those are accounts that I started talking about in chapter 3 way back when. And a contra asset account, in this case, what we're looking at here is we cannot directly write off against bad debt or against accounts receivable. So when we're using the allowance method, we can't do this entry, debit bad debt expense, credit accounts receivable. That violates the matching principle. Now, the allowance is based on the matching principle. So again, I cannot directly write off bad debt expense against AR. So what we're going to do is have a contra asset account called the allowance for bad debt. Now, the contra accounts always reduce some type of asset, liability, or revenue account. In this case, the allowance for bad debt is going to reduce the accounts receivable balance. So our accounts receivable should always be recorded at their gross amount. The allowance for bad debt is kind of a pool of accounts out there that we're estimating for bad debt expense. So we're estimating some of our accounts receivable is going to be bad, and we're going to have to, we won't collect on those. Now, with accounts receivable, we don't want to. Most investors and creditors don't really want to know about the gross accounts receivable. They want to take a look at the overall net accounts receivable or net realizable value. Now, net realizable value is always the accounts receivable gross minus the allowance for doubtful accounts, and that's always going to come up to the net realizable value. Now, in this case here, Smart Touch has learned that they estimate about $80 of its $4,400 accounts receivable are uncollectible. So what's going to happen here is as of December 31st, and normally companies are going to make these type of entries right before they prepare financial statements. Now, in December 31st, we're going to recognize bad debt expense of $80 and a credit to the allowance for bad debts of $80 also. So we're going to record bad debts for the period here. So again, it's a debit to bad debt expense because that's a cost of providing credit sales, and we'll credit the allowance for bad debts for $80 also. So as you can see, there's no debits or credits to the actual accounts receivable. We're going to book the expense to the allowance or the contra account out there. Now, the allowance for the allowance for bad debts is always a contra asset account, and as such, the normal balance is always a credit amount. Now, the allowance for bad debt is an offset against accounts receivable. You're always going to see the allowance for bad debt on the balance sheet on the asset side of the balance sheet. But since it's a contra account, it's going to have, or most assets have debit balances the allowance for doubtful accounts is a contra account, it's going to have a credit balance, even though it's on the asset side of the balance sheet. Just like this one here. On the balance sheet, here's how your allowance for bad debts is going to look. You're going to have your accounts receivable at $4,400 less the allowance for bad debts, or minus $80. The $4,320, that's the net realizable value of your accounts receivable. That's what we're really looking to get back in the way of cash. If all those accounts receivable we were to get cash on accounts receivable, we're estimating that we'll get about $4,320 in the net realizable value of accounts receivable. Now, writing off uncollectible amounts, the allowance method. An allowance is established for estimated uncollectible accounts. In this case here, if we're going to be actually writing off an uncollectible account, we've already estimated it with bad debt expense. So what we need to do here is take a debit to our allowance for bad debts, because we've already reserved for it. Now, we determined that account is going to get written off. Normally, we're going to make a debit to the allowance for bad debt, and then we'll make a credit to the actual accounts receivable, or the AR. Now, the entry to write off an account under the allowance method, this is not going to have any effect on net income at the time of entry. We've already recorded our expense with the bad debt expense a while ago. So whenever we're writing off an account, it's basically a debit to the allowance for bad debts, and then a credit to the accounts receivable amount. So it's going to look something like this. So in this case, Smart Touch determined that it cannot collect an account of $25 from its customer, Sean Clark. So in this case here, we're going to make a debit for the allowance for bad debts, and then we'll make a credit out there to accounts receivable Clark for $25. So in this case here, we've wrote off the account. This is the time period here. Once we write off the account, this is when we make the credit to accounts receivable. Other than that, with bad debt and also with the allowance for bad debts, normally that's going to go through the allowance for bad debt account. So the entry to write off a receivable reduces the amount of the allowance for bad debt account, and also the accounts receivable. But again, it does not affect the net realizable value shown on the balance sheet. So you can see here before the write-off, we had $4,400 in accounts receivable, less an allowance of $80. So we had a net realizable value of $4,320. Now after the write-off, here we've got an accounts receivable of $4,375. And then we'll take less the allowance for bad debt, because we wrote off the $25. So the allowance for bad debt is $55. So my net realizable value before and after the write-off is the same at $4,320. Now, remember when we wrote off the $25 receivable from Sean Clark? Now, on March 4th, Smart Touch actually received the money from Clark. So in this case, what we're going to have to do is reinstate the accounts receivable. So we're going to have to debit accounts receivable Clark of $25 and credit the allowance for bad debt for $25 to reinstate that previously written off account. And then once we have the account reinstated, then we'll debit cash and credit the accounts receivable for Clark, because we've collected the cash on account. So again, it's all good on that one. Now, number 7, the allowance method of accounting for uncollectible receivables. Let's see, the allowance method is used to measure bad debts. Is it A? B, violates the matching principle. No, it does not. C, records bad debt expense in the period the account receivable is written off. No, that's the direct write-off method. And D, requires the use of a contra liability account. No, it would be a contra asset account. So in this case here, this one is A. A is the best answer of the bunch. The allowance method is definitely used to measure bad debts. Number 8, the allowance for bad debts account is A, a liability account? No. B, holds the pool of unknown uncollectible accounts? You know what? That one sounds good. Let's see. C, increases with a debit? No, it's always going to increase with a credit. And D, is added to accounts receivable? No, the allowance the allowance for bad debt account is a contra account, so it's going to be a reduction of the accounts receivable to get to the net realizable value. This one is going to be B. It's the pool of unknown uncollectible accounts. So we've got a pool out there. We just don't know which accounts are going to be uncollectible. Number 9, when a company uses the allowance method to measure bad debts. Let's see. A, bad debt expense account is debited when an account is written off? No. The amount of bad debt expense is estimated at the end of the accounting period? Definitely like that one. C, the normal balance in the allowance for doubtful accounts is a debit? No, it's a credit. And D, the amount of bad debt expense is not estimated at the end of the accounting period? B or D? B or D? B or D? I'm going to go with B on this one. The correct answer is B because you're estimating at the end of the accounting period. Which of the following is true of the balance sheet presentation of the allowance for bad debts? Normally that is going to be a contra asset account, and it's going to be related to accounts receivable. Number 10 is D. Number 11. On January 16th, Half Circle Inc. sold $5,000 of merchandise to Arnold on account. Half Circle could not collect cash from Arnold and wrote off the account. Prepare the journal entry to record the write-off, assuming Half Circle uses the allowance method. This one should be a debit to the allowance for bad debts and a credit to the allowance or a credit to accounts receivable Arnold for $5,000, and it is.